If you have over $200,000 sitting stagnant in your bank, retirement account, or home equity, then you're literally losing money. On this show, you learn how to get that money working for you consistently and conservatively. Learn to grow your nest egg with your host, Sean Winslow. Let's dive in.
What's going on, everyone? I'm Sean Winslow, and this is the Multifamily Money Podcast. And on today's Multifamily Mondays episode, I'm going to be talking about why I love multifamily real estate. After all, this is a podcast that focuses on investing in multifamily real estate to generate passive income, so then you can achieve financial freedom. And as you know, on Fridays, we go into, you generate that passive income, but it's not what you make, but what you keep. So on Fridays, we go into kind of the personal finance aspects of money management. But on today's episode, I'm going to get into why I love multifamily. But before I do that, I just want to read a review someone left for me. Again, if you're finding any value in any of these episodes, please do get on and leave a rating and review. It only helps get this show in front of more ears and eyes. So that would be great. So for today's review, it's from OC Justin. He titled it Game Changer. And the review is far exceeded what I expected. I'm relatively new to the RE real estate game, but the way they unpack complex concepts in clear and understandable ways has kept me coming back for more. Well, thank you, Justin. I appreciate that. And again, please leave a rating review if you found any value in this. It only will help the show get to more people. So let's just get into it. So before I get into why multifamily, I think it's important to break down why I love real estate as a whole, as an investment. There's, many different ways to grow wealth and invest your hard-earned money. And I came from the background of, traditional financial services. I worked for a company that had, funds, mutual funds, ETFs, separately managed accounts. And these primarily invested in, stocks and bonds. And after being in that world for so long, I realized that wasn't the best way to grow wealth. One, it's not cost effective. Two, it's not tax efficient. And three, it's just so volatile. And I'll get into this more as this episode goes along, but volatility is one of the biggest factors that can really be detrimental to your portfolio. It erodes your returns, it erodes your portfolio. So after leaving that world, real estate had always been in the back of my mind. I always wanted to, the original goal was to make money in that career and take that money, invest in real estate for my own personal portfolio. Then I kind of just realized, why not make that my career? Like, I want to help people grow wealth, and I know that what I'm doing is not the best way to do that. So why not help others grow their wealth in what I feel is the best investment vehicle, real estate? So that's what I did. So let's get into why I believe real estate is the best investment vehicle to grow wealth. So before I just get into it, I just want to read a quote from Andrew Carnegie. He came from the industrialist era, with the Rockefellers, the Carnegies, the Vanderbilts. He made his money in steel. But he has a very famous quote, which I know I've mentioned before, and that's that 90% of all millionaires become so through owning real estate. More money has been made in real estate than in all industrial investments combined. The wise young man or woman or wage earner of today invests his money in real estate. And there's also a great one from Franklin D. Roosevelt, President of the United States. Real estate cannot be lost or stolen, nor can it be carried away. Purchased with common sense, paid for in full, which I would argue that, and managed with reasonable care, it is about the safest investment in the world. And let's just get right into it. So why real estate? Number one, it's a great place to store value. There's only a finite amount of land on the planet, thereby making a great way to store value. And it's why we've seen a lot of foreign money recently come in to buy real estate in the United States, because as their country faces inflation or there's extreme volatility in their stock markets, they bring their money here just to store value. And that's one of the reasons why prices have gone up significantly, especially in the commercial side. But even we started to see it in the non-commercial residential side, is that they're willing to pay more than you or I may be willing to, or other investors, just because they're bringing it here just to store its value, not necessarily make a return. It's just safer for them to store it here than it is to leave it in their currency in their country or in their stock market where it's extremely volatile and they're losing money essentially by just keeping it there. It's also why we've seen big institutional players, like I'm sure you've seen this over the news, like BlackRock, who are scooping up large amounts of real estate during the pandemic. It's because it's a way to hedge and store value. There's also the second aspect is natural appreciation. So this is just, it's a tangible asset that you own, and over the long run, historically has always increased in value. Yes, there's dips, but over the long run, it has historically increased in value. Obviously, just like anything, there's an exception to the rule. That's why the cliche term, location is so important. And if you buy in the right place, historically, it's going to go up in value. And if we just look at the numbers, the average home all over the world increases in value by 3% per year. Now, that's on average. And that now, if you're targeting trending markets, hot markets, you're going to see that increase to a value of 6% per year, meaning that you're doubling your money every 10 years just by holding the real estate and doing nothing else. Third is one of my favorites, forced appreciation. And this is what we do on any project we invest in. And that's you're coming in, bringing extra money to improve the property, improve the interiors of the units or the property, the exteriors, so maybe a new roof, cleaning up the landscape, fresh paint, and on the inside, you're doing fresh paint on the walls, new flooring, new counters, new cabinets, new lighting, and the list goes on. And what you end up doing is you're increasing the value of the property. And then you're forcing appreciation, because then when you go to sell it, it's worth more because you've put money into it and improved the property. And then when you get in the commercial side of things, you're also increasing the rent by doing that as well. So then you're forcing appreciation at that end, because on the commercial side, you're buying based off of income, which we'll get into later. Next, leverage. This is one of the most powerful reasons people should invest in real estate and why people do invest in real estate. You're using other people's money to grow your wealth. Yes, you're putting your own money into it, the down payment, closing fees, closing costs, but also other people's money. You're using a bank. They are lending you the money, which is other people's money. Other people deposit money in the bank, and then the bank turns around and takes your money and lends it and makes money off of that. So this is how true wealth is made, because you're using leverage. You're buying more than you normally could buy. So let's say you had $100,000 to invest and you decide to invest in the stock market. You only can buy $100,000 worth of stocks on that day. Yes, now you can argue there's margin accounts, but that's extremely risky. And those are, if you're smart, you're only doing that for the short term. That's only a short-term investment strategy, because it's based off the underlying asset, which is the stock, which we know is extremely volatile. So if you're taking a long position using margin, and if the stock dips below a certain level, there's something called a margin call, where then you have to put more money in to keep you at that level. And also, in a margin account in stocks, it's only usually 50% loan to value. So meaning they'll only leverage you up to 50% of the value of what you're buying. Whereas in real estate, that could be anywhere from 70 to 80% LTV, loan to value, meaning you only have to put anywhere from 20 to 30% down, which then that leverage is even more powerful at that value. So let's look at example. If you were to buy $100,000 worth of real estate, you put 20% down, that means you can buy a $500,000 property. So now, if you have those two different portfolios, in the stock portfolio, you bought $100,000 worth of stock and it went up 10%. Now it's worth $110,000. That's a 10% gain, which no one can sneeze at. That's a great gain. But if on a piece of real estate that you invested $100,000 and then used leverage to get and got a loan from the bank for the remaining $400,000, that property, that 10% gain is on the value of the property. So now that property is worth $550,000, and the gain on your $100,000 is 50%. That's right, 50% increase on your money, also known as cash on cash return. That's way more than 10%. And that's the power of leverage. You get a return on your money and you're getting a return on the money the bank lent you. That's powerful. That's how you're able to grow wealth at a considerably greater rate than, say, any other type of investment, in my view. Next point is amortization, or others paying down your debt. So the type of real estate I invest in, multifamily, is rental real estate. So it's where you have a tenant in place and they're paying you rent to use that space. And so they're paying your mortgage, both the interest and the principal. They're paying that down over time. And so that's amortization. As you pay that debt down, your equity increases. So someone else is increasing your equity every month for you. So you're just holding that real estate and getting equity and not putting any more money into it. Now we get into tax benefits. So the government incentivizes real estate investors. And you may ask, why are they doing that? Well, one of the necessities of life is housing. You need food, water, shelter. And I'll get more into this later on in the episode, but there is a huge deficit in housing in the United States and across the world. So the government wants to incentivize you to, one, develop and create more housing, and two, maintain the existing housing. And so they do this by a few ways. One, there's something called depreciation. So just to get a little in the weeds on it, not too far into it, but depreciation essentially is you have an asset and it ages over time. Things deteriorate and break down. So, and the government knows this, so you can depreciate and deduct that and offset that from your taxes, because they know that asset is depreciation deteriorating. So they incentivize you to, one, take care of that property because they're essentially giving you money back to do so. And in the current tax law, there's something called bonus depreciation, which allows you to take the depreciation up front. And on top of that, you can go further into it and do something called a cost segregation analysis, where you're essentially having engineers come in, they're looking at the property, they're looking at all the different aspects of the property. So, you got the foundation, the roof, you got the wiring, the plumbing, you got the windows, the flooring, the list goes on. Those all have different life expectancies, so they can be depreciated over different time frames, 5 years, 10, 15, 20, 27 and a half. And that's powerful because the shorter that time to depreciate, the more bigger chunk you can take up front. And the bonus depreciation allows you to take it, a great percentage of it up front in the first year. And for instance, on one of our recent deals, we had over $5.6 million in depreciation. And that equated to every $100,000 an investor invested, they got $40,000 in depreciation. That's powerful. They could take $40,000 and essentially, depending on their circumstances, always consult the tax advisor. They could offset that against passive income. So essentially, the cash flow they're making from the property is not taxed because that $40,000 more than covers it and cover any other type of passive income they have. And the second big thing, tax benefit, is something called the 1031 exchange, where, when you sell a property and there's a capital gain, either from, natural appreciation or the forced appreciation we just discussed, there'll be a gain on the property and you have to pay taxes on that. However, like I mentioned before, the government wants to incentivize you, wants us to maintain properties so they don't deteriorate and then we lose even more housing units. So what they do is they let you sell that property, take the gain, and roll it into another property to invest in. And if you do that, there's a time period. It's about 90 days, 45 days to select the next property, and then 45 days to close. When you do that, they do not tax you. And it's not tax-free, it's just deferred. So you're essentially kicking the can down the road. And then this is where it becomes extremely powerful. a lot of big investors do, is they never completely sell and get out of the market. They just keep 1031 and rolling it over. And what happens is when they go to die and they give this their benefits, say their children, there's something called step-up basis, where the original cost basis for that investor before he died was that first property he bought. And then he kept 1030 and 1031, 1031. And over time, that's going to be a huge capital gain that if he was to sell, he would have to pay. However, when he passes away and it goes to his beneficiaries, his children or her children, her beneficiaries, that step up in basis goes to that day when that individual passed away, what those properties were then worth. So essentially, the children could then go sell the property and not pay any capital gains tax because that's their new basis on that current market value. And that's where it becomes extremely powerful to grow your wealth, because kind of like a retirement account, you're growing your wealth tax deferred. So you can keep growing it and take more money instead of having to take some, pay taxes, and then you're able to invest less. No, you can defer those taxes to later so you can invest more now. And that's extremely powerful to grow wealth. Now is another one is cash flow and income for life. So that's assuming you're going to buy and hold. You're going to keep cash flowing, assuming you bought it and managing the property correctly. You're going to cash flow every month. And that's super powerful because unlike a stock portfolio, unless you're dividends, but then again, a dividend paying stock on average, I looked up the other day for the S&P 500 is 1.32%. You're going to have a lot of money to live off 1.32%. Whereas in rental real estate, it pays you monthly rent. So there's monthly cash flow that you can live on. And all while it's still paying down that debt and increasing your equity, and you're getting money on top of that, known as cash flow. And if you hold it for a long time, depending on the term of your loan, if it's 15, 30 years after that, there's no more debt. And then the cash flow increases exponentially because one, you no longer have to pay debt, and you could be able to increase rent over time because it keeps up with inflation, which we will get into next. And that leads us into the next one. It's an inflation hedge. As the money supply increases, our current day dollar does not go as far as what it once did. So that's, for instance, how most people commonly look at it is you go to the grocery store and your $5 will not go as far as it did yesterday, a year ago, 5 years ago. It's going to take more money to buy that same carton of milk, that same carton of eggs, that same bread. But what is powerful about real estate is that it protects and hedges against inflation. It's a great way to do that as inflation transfers wealth from the lenders to the borrowers and from the savers to the debtors. Cash flowing real estate investors get the benefits of their tenants to pay all the mortgage interest, pays down some of the mortgage principal, and if done right, covers the expenses and pays you some on top of that. Now, there's 3 ways that real estate hedges against inflation. The first is asset inflation. So that we previously spoke about that natural inflation, also, forced appreciation. And so say you have a $1 million property, and over a period of time, inflation has increased that property 10% in value. So now it's increased to 1.1 million, but your purchasing power has also gone down 10%. So wouldn't that mean you're kind of at par, break even, like nothing really happened? And the answer to that is no, because if you bought using leverage, the debt you have on the property, you only put $200,000 down and the rest was financed. And so that 10% inflation has now increased your equity from $200,000 to $300,000. That's a 50% gain. Now, if you want to, back out that inflation, you can do so. You're still making a significant gain. And that's not even taking into account the cash flow you made and the tax benefits. Now, the second way real estate hedges against inflation is an inflation profit benefit you get from the debt debasement. And what I mean by that is let's say you have $1 million loan on a property, and there is, say, 3% inflation per year for an extended period of time, that's the average. After the first year, you only owe the bank $970,000 in inflation adjusted dollars because they're charging you a nominal dollars. They don't increase it when inflation increases. So then after year 2, you only owe $940,000. And then after year 3, you only owe $910,000 in nominal dollars, or excuse me, in inflation adjusted dollars, because they only charge in nominal dollars, and so on and so forth. So that's giving you a $30,000 a year profit tailwind. And as inflation goes up, so does that tailwind. If it's 5% inflation on a $1 million loan, that's $50,000 tailwind. The third way real estate is a hedge against inflation is cash flow enhancement. And we all know as inflation increases, so does the amount a landlord and real estate owner can charge for rent, because cost of living goes up, rent goes up with it. But on top of that, your cash flow goes up even more than inflation. And that is because your largest expense, your mortgage payment, stays fixed over those years. But your rent goes up, thereby your net operating income and cash flow going up at a faster rate. And that is super powerful, that a lot of other investment vehicles cannot do. And now I've laid out my cards why real estate is my favorite investment vehicle, but we all know there are a lot of sectors within real estate that you can invest in. You've got, from a residential standpoint, you've got the non-commercial, single family and 1 to 4 unit small multis that you can invest in. We've got the bigger multis, 5 and above, but to me, bigger multis, I would say 75 and above. And then you got commercial. So on commercial, you have, your retail where you're going to go in, buy clothes, food, etc. And you got office, you've got self-storage, RV parks, mobile home parks, and the list goes on. But I love commercial multifamily, and here's why. So first, let's look at residential versus commercial. There's a shortage of 3.8 million housing units in the United States. There's clearly a demand. The supply is not meeting that demand, and we're at an all-time high. Landlords are even experiencing bidding wars for the rental units. I have never heard of this before, and I've actually experienced this. I'm thinking of one specific unit that came to market earlier this summer of 2021. In less than a week, that one unit had over 17,000 views online. Over 17,000 for one unit, and ended up in a bidding war. Their potential tenants were offering to pay for months they weren't going to even be in the unit just to get it. It's crazy. So I've never seen this before. And at the time this episode comes out, I have over 390 units totaling over $30 million worth of real estate. And it's the first time I've ever seen bidding wars by renters. You hear bidding wars for people trying to purchase real estate, but just to rent a unit, it's crazy. So there's clearly demand for housing. That's why I love this side of real estate. It's also one of the main necessities of life, right? Food, water, and shelter. It's something we're always going to need. And the pandemic has really shown this. It's shown us that we can work, buy clothes, buy food virtually, but we cannot live virtually, or at least Jeff Bezos and Amazon haven't figured that out yet. And let's hope they don't in my lifetime. But clearly shows that there is a demand for this, and it's something that is a necessity, and people are always going to need a place to live. And the pandemic has shown not only that we can't do it virtually, but that housing is very sacred and special to people. It's a way they can get away from things that are going on, and it's something that they're always going to need. So that's why I love the residential side of real estate. And now there's two main differences once you get into, residential from an asset class standpoint. And that's, your single family or your small multis versus commercial. So commercial versus non-commercial. And I think, as you most know, clearly I'm a big proponent of commercial real estate. And there are many reasons for that. I'll get into a few here. So first, I would say is management. Any type of business you're going to run, it's all about people and processes. People, systems, and processes. That's how any efficient business works. You could have the best product, the best widget out there, the best service out there, but if you don't have the right people, the right systems in place, it doesn't matter. You're not going to grow. You're probably going to go out of business. So when it comes to commercial real estate, specifically 75 units and above, what that can afford you is one, third-party property management, and two, on-site staff. When you get into the smaller ones, yes, you can have third-party management, but it cannot afford on-site staff. And so what I mean by that is you can have a property manager, a leasing agent, and a maintenance crew on-site. Now, depending on the size of the facility, the numbers of each of those positions will vary. But that is super powerful because one, you have your management company overseeing the on-site staff, and then the on-site staff is overseeing the property. So you have a leasing agent whose job it is to find people to rent your units. And then you have the manager that is overseeing everything, and then the maintenance crew, which is there just for that facility to fix any problems there may be. And that will help you run more efficiently. It'll help both your top and bottom line, which this is all about. And I don't know about you, but I'm in this business to run efficient, profitable businesses. And I look at each complex as its own business because that's what it is. Each complex is different. Yes, for the most part, the systems and processes are the same, but each property is its own business and it needs to be run that way. And then that kind of leads into scalability of large commercial apartment complexes. There's people that own 1,000 single family or 1,000 small multis, but it's really hard to scale that and run it efficiently because they're all over the place. They're not confined to one area. You're having a maintenance guy, property management company running all over the place. It's just not efficient. You can't be as timely to fix maintenance issues. It's harder to fill units because you have units all over the place that you have to take potential renters to. And it's really hard just to keep a grasp on everything that's going on at every single property, because whereas on a big apartment complex, you have those staff that are on site daily. Like I don't care who you are, you can't afford to have someone go to every single one of your properties when you get that big, when they're spread out, when they're single family, 1,000 units. It's just, you can't afford that. If you did that, you wouldn't be running a profitable organization. And that also comes to just, when it comes to scalability, it just comes to, you can use economies of scale to your benefit. When you're improving the property, buying 100 refrigerators, you're gonna get a lot better deal than buying one. And then also when you have big complexes around each other, you can leverage your resources a lot easier than you can when you're spread out all over the place. Next is debt. When you finance a big commercial, whereas when you're financing 1 to 4 units, you're using, your traditional lender like you would just go buy your own home. And yeah, they look at it a little differently because it's investment property, but there's recourse there, meaning that the collateral falls back on you. Even so, if something was to happen, you got to sell the property and it didn't cover that outstanding debt, they'll go after your personal residence, all the assets you own, your cash, everything. Whereas non-recourse, the only collateral they have is the property itself. And you can only really find non-recourse when you get into the commercial grade, especially the bigger properties, because that's a business. So they're underwriting it like a business, and that business should support the debt. And that's how they underwrite it. So there will be no recourse. Obviously, there's some type of debt where there is, right? Even commercial, but Commercial gives you the ability to do non-recourse, which is super powerful because it's not going to affect you. If something was to go wrong, it's not going to affect your investors. Also, whereas when you're buying, a lot of single family homes, there's the 10 mortgage limit. Obviously, there's ways to get around that, but then it does get pricier. More flexibility in structuring deals on the commercial side, just because lenders love multifamily. It's less volatile. All the things I just spoke to above, there's, supply demand benefits, huge demand in the market, not enough supply. And it's just a necessity in life that everyone needs a place to live. So there's a lot more flexibility in structuring deals. They'll find ways for it to work. Next is vacancy. So vacancy and turnover are two of the biggest things that hurt any type of property, because vacancy, obviously you're not getting paid for a unit that's there. And turnover is when people leave. You've got costs, one, to go find a new tenant. Two, you got costs to turn that unit around and clean it up, do a little value add. And then the time of not getting the rent is lost too. And when you have say you have 100 units all in one place, one building. When you have one vacancy, that's 1% vacancy and 99% occupancy. When you have a single family home and you have one vacancy, that's 100% vacancy and 0% occupancy. So there's that risk where vacancy does not generally affect a larger property as severely when it comes to a few people leaving. Obviously, there's other circumstances that can happen when there can be people leaving by the masses, but that's why you do demographic research and you invest in areas that don't have one major employer that could just decide to leave. There's more mix and diversity of employment. There's also population growth, income growth, job growth, and so on. But vacancy can really hurt your smaller multis and your single family homes, just because a person can leave and then you have to go fill that. Now, I know in kind of the market we're in right now, it's really hot, so it's not as difficult, but you still have those turnover costs, and you want to prevent that as much as possible. And so what a lot of single family and smaller multi operators will do is they won't raise the rent or won't raise it as fast because they want to keep that person staying there. And that's just one, I get it, and that's smart in that sense, but it limits your return over time. Whereas in the bigger multis, you'll see less of that because they want to increase the rent and keep it up with inflation to help, one, battle inflation, but also help their bottom line. They aren't as worried as one or two or three people leaving because of the scale and the size of the property. Now, as I've been mentioning, this is run as a business when it gets to commercial. Single family and smaller multis are not. So now you're buying the property based on the income and the market cap rate. So you take the income, you divide it by the market cap rate, and that gives you your purchase price or the value of the property. And they have an inverse relationship. As cap rates go up, that property value goes down, assuming the income stays the same, and vice versa. When cap rates get compressed and go down, the market value, the purchase price is going to go up in that property, assuming the net operating income stays the same. So this is extremely powerful. Whereas most people are familiar, the residential side of real estate is bought and sold based off of comparables or comps. So what did your neighbor's house down the road that's very similar to yours sell for, and so on and so forth. And that's what they're going to base the sale price on. Whereas in the commercial side, no, it's what's the net operating income of that property, and now what is the current cap rate in that market. And so that's where it becomes extremely powerful, where you can force appreciation and push that bottom line, that NOI, up and up and up. It's going to exponentially increase as that cap rate comes down. And that's why one of the main reasons I love this game of commercial multifamily is because we can control that bottom line. You can force appreciation and you can reduce expenses. And then people love to buy net operating income, cash flow. They want cash flow. They want an easy button where you've come in, you've forced the appreciation, you've mitigated the expenses, you've set up systems and processes and put the right people in place. They can just get a turnkey solution and they'll come in and they'll pay a lot of money for that net operating income. And that kind of parlays into value add and why I love multifamily. Now, you can do this with other asset classes too, but when it comes to multifamily, it's more that you're increasing the quality of life for the tenants. So it's bonus and benefit twofold. You're increasing the quality of life for your tenants, making a place they're proud to call home, and you're also increasing the bottom line for you and your investors. And you simply do that by bringing in CapEx, so capital improvement dollars, and you improve the property. And it's like you're improving a business, because when you're improving that quality of that property, one, you can maximize rents, and then you can put, efficiencies in place to reduce expenses, increasing the NOI, thereby being able to sell it for more. And then tax benefits. We hit on this as real estate as a whole, but I just wanted to hit on what we've seen in the multifamily space. Multifamily has one of the higher benefits of depreciation, cost segregation analysis. And like I mentioned before, we had a property that had over $5.6 million in depreciation. And our investors, for every $100,000 invested, they got $40,000 in depreciation. And that's super powerful to help grow wealth, as I mentioned before. So if you have to pay less in taxes today, you can invest more today to grow more for the future. And also the 1031 exchange can easily be done and often done in multifamily. And that's how you can level up into bigger and better quality multifamily apartment complexes. Because, as you make a gain on your current property, then you can go buy something bigger due to leverage. And the last point I want to hit on is volatility. I alluded to this earlier. Volatility erodes your portfolio. We even used to sell this when I was in the financial service industry. Invest in our product because we're less volatile than our competitors. And if you look at volatility, if we look at a 20-year period of the S&P 500, let's say from 2000 to 2019, it averaged about 7.5% return for average annual return, 7.5%. And that's because you had some years where, it was up 20%, 30%, and other years where it was down 30%, 20%, and then some where it was, 10% return, 6% return. And that creates that volatility and averages out to about 7.5%. But if you were to look at another portfolio where it had a fixed return of 7.5% for every year during that 20-year period, it would have the same average return, right? Yeah, 7.5% as that S&P 500 index. However, the remaining dollar value of your portfolio is different. And that has to do with the erosion caused by volatility when you look at the actual ending balance. And that's because if you have $100,000 and you lose 10%, you're down to $90,000. Now, next year, you have to make more than 10% just to get back to whole. And that erodes your money over time. So those two different portfolios, one would have negated if you started with $100,000 to over $300,000. Now, in that other portfolio that had the fixed 7.5% annual return, that would have negated to over $400,000. And you look at the difference, it's an over $100,000 difference in 20 years based just from volatility. And that doesn't take into account the fees and taxes associated with a stock portfolio. So those are kind of the things why I love real estate, why I love multifamily, and why it's led to 90% of millionaires that have invested in real estate. It's just extremely powerful to build wealth. it's like rocket fuel to your investment portfolio. And yeah, I love this. That's why I can't even express the words right now. I just love multifamily real estate, and it's something I'm extremely passionate about. And I just want to teach more people about it and let them know that they can invest in this. And if you want to invest, in a single family or small multi, that's awesome. I started off doing that as well. That's still a great way to grow wealth. But I just love the commercial side of it because it's a lot more powerful. It's run as a business. There's more people that are willing to buy more money. It's not subject to the volatility of, say, like a housing crash, like in 2008, where we saw, your residential single family homes just plummet in value. If we look at 2008, for example, the S&P 500 and Dow were both down, they were down over 20 and 30%, whereas multifamily was down 6%, and it made money back years before the stock market did. And that's because it's based off of income and all the benefits I've mentioned before. So I commend anyone who wants to get into real estate, improve their life, improve their family's life, create generational wealth, create financial freedom, so you can do the things you want and give back, make this world a better place. Because it's already a great place, but we can make it so much better. And I just want to be an avenue for people to learn how to use real estate to create financial freedom. So yeah, reach out. You can find me on Instagram. That's where I'm kind of most active. My handle is Shano Wins. And also on LinkedIn, search Sean Winslow. Company's Greenbrier Capital Group. And yeah, we love to improve lives through real estate. So thanks for tuning in, everyone. Catch you on the next one. Hey, this is Sean Winslow. After being in the financial service industry for years and having candid conversations with good people just like you, I realized that so many of us are wanting an investment strategy that provides solid returns and consistent income without the bumps in the road. There's little known secret that your financial advisor doesn't want you to know. There is an investment out there that is less volatile and the returns are stronger. Get more details by going to greenbriercg.com and clicking on the free e-report. And by the way, if this show has provided you any value, then feel free to leave an honest written review and of course share it with a friend who needs it. See you next week for another great show.